Have you ever wondered what keeps our financial markets from spinning out of control during times of extreme excitement or fear? To maintain a stable environment, we use a system called price limit circuit filters. These are rules set by SEBI that require stock exchanges to use price bands, which essentially act as a safety net to prevent any trades from happening outside of a safe price range. Building on that need for safety, let's see how these rules apply specifically to currency futures involving the Indian rupee. Interestingly, there are no fixed daily price bands for these contracts. Instead, we use what are called operating ranges. For short-term contracts lasting up to 6 months, the range is a profit of 3% or a loss of 3% from the base price. For longer contracts over 6 months, this range expands to a profit of 5% or a loss of 5%. If the market starts moving strongly in one direction, these bands can be relaxed in small steps of 1%. Now that we understand the percentages, let's look at a practical example from March 2024 to see how this works with actual numbers. Imagine a USDINR contract expiring in April with a base price of 83 rupees. Its safe trading range would be between 80.51 rupees and 85.49 rupees. On the other hand, a longer term contract expiring in October with a base price of 84.50 rupees would have a wider range from 80.275 rupees up to 88.725 rupees. While we have focused on the rupee, you might be wondering about contracts involving other world currencies. These are known as cross-currency futures. The logic here is exactly the same as what we just discussed for the rupee. They also use the same operating ranges of 3% or 5% depending on the time left until the contract expires. And they use the same 1% steps if the price limits need to be relaxed. Futures are relatively straightforward, but options require a slightly more detailed approach to set their limits. For currency options, the operating range is calculated every single day using a specialized number called delta along with the previous closing price and how much the market is swinging, which we call volatility. These ranges can even be adjusted during the trading day if the price moves beyond a certain point of the set limit. Once we understand the safety boundaries, it is time to look at the actual costs you will face when trading in the ETCD market. There are three main types of costs: statutory levies like GST and stamp duty paid to the government, regulatory charges paid to SEBI or the exchange, and finally the brokerage you pay to your trading member. One very important thing to note is that the securities transaction tax or STT is not charged on currency derivative trades. Since we mentioned brokerage as a major cost, let's dive into the specific rules and limit how much a broker can charge you. For futures contracts, a broker can charge a maximum of 2.5% of the total contract value. For options, the limit is either 2.5% of the premium amount or 100 rupees per lot, whichever of those two figures is higher. There is no minimum amount required, so you can often find very competitive rates. Knowing the maximum limits is helpful, but the actual amount you pay often depends on the type of broker you choose. Full service brokers usually charge more because they provide extra research and advice. Discount brokers offer much lower rates, while online brokers focus on everyday retail traders with even lower costs. Many brokers also offer different plans based on how much you trade or specific schemes for different types of contracts. Besides your broker, SEBI also requires certain fees to keep the whole market regulated and running. For currency derivatives, every broker pays a turnover fee of 10 rupees per crore of total trading volume. Additionally, clearing members and self-clearing members have to pay a flat registration fee of 50,000 rupees every year to keep their license active. Another important part of your trading bill is the stamp duty, which has recently been simplified across the country. Under the One Nation, One Agency policy, the central government has made it easy for states to collect this duty in one single place through the exchange or clearing corporation. This money is then shared with the state government where the buyer lives, making the whole process much smoother for everyone involved. To wrap everything up, let's look at the exact rates and how different contracts are valued for this purpose. The stamp duty rate for currency derivatives is very low at just 0.001%, and it is only paid by the buyer. When calculating this cost, a futures trade is valued at the actual price you traded at, while an options trade is valued based only on the premium amount.